which normally is made in the first week of October. This time, because of holidays next week, we have kept it on 30th of September. As you are aware, this process of the governor making a statement started on March 27th when we entered the period of the pandemic. And thereafter, we have continued with this practice because we have been confronted with, the world has been confronted with one crisis after the other. And this statement by the Governor RBI, where we spell out the details of RBI's assessment of domestic and global situation, I think is a useful communication tool for all the stakeholders and members of the public. That is the feedback we have received. Thank you for all your patience and cooperation in listening to our communication. And please permit me now to go ahead with this time's statement. In the last 2.5 years, the world has witnessed two major shocks: the COVID-19 pandemic and the conflict in Ukraine. These shocks have produced profound impact on the global economy. As if that was not enough, now we are in the midst of a third major shock, a storm arising from aggressive monetary policy actions and even more aggressive communication, especially from advanced country central banks. The necessity of such actions is driven by their domestic considerations, but in a highly integrated global financial system, they inevitably cause negative externalities through spillovers. The recent rate hikes and forward guidance about further big rate hikes have caused tightening of financial conditions, extreme volatility, and risk aversion. All segments of the financial market, including equity, bond, and currency markets, are in turmoil across countries. There is nervousness in financial markets with potential consequences for the real economy and financial stability. The global economy is indeed in the eye of a new storm. Despite this unsettling global environment, the Indian economy continues to be resilient. There is macroeconomic stability. The financial system remains intact with improved parameters. The country has withstood the shocks from COVID-19 and the conflict in Ukraine. Our journey over the last 2.5 years, our steely resolve in dealing with the various challenges, gives us the confidence to deal with the new storm that we are confronted with at present. Let me now touch upon the decisions and deliberations of the Monetary Policy Committee. The Monetary Policy Committee met on 28th, 29th, and 30th September. Based on an assessment of the macroeconomic situation and its outlook, the MPC decided by a majority of 5 members out of 6, and you guessed it right, to increase the policy repo rate by 50 basis points to 5.9% with immediate effect. Consequently, the standing deposit facility, that is SDF rate, stands adjusted to 5.65%, and the marginal standing facility, that is MSF, and bank rate to 6.15%. The MPC also decided by a majority of 5 out of 6 members to remain focused on withdrawal of accommodation to ensure that inflation remains within the target going forward while supporting growth. I would now like to explain the MPC's rationale for its decisions on the policy rate and the stance. The global economic outlook continues to be bleak. Financial conditions are tightening and recession fears are mounting. Inflation continues to persist at alarmingly high levels across jurisdictions. The enduring effects of the pandemic and the geopolitical conflict are manifesting in demand-supply mismatches of goods and services. Central banks are charting new territory with aggressive rate hikes, even if it entails sacrificing growth in the near term. In this milieu, nervous investor sentiments have triggered a flight to safety. The US dollar has strengthened rapidly to a 2-decade high. Several advanced and emerging market currencies are facing sharp depreciation pressures. Emerging market economies, that is EMEs in particular, are confronted with challenges of slowing global growth, elevated food and energy prices, spillovers from advanced economy policy normalization, debt distress, and sharp currency depreciations. Now, against this challenging global environment, economic activity in India remains stable. And that's a very refreshing point. It gives us, that's why in the beginning I said that it gives us the confidence of even dealing with the current challenge which we are confronted with. While real GDP growth in the first quarter this year turned out to be lower than our expectations, nonetheless it was 13.5 and perhaps the highest among the major global economies. So the real GDP growth in the first quarter, the late recovery in Kharif sowing, and the comfortable reservoir levels that we have at present, improvement in capacity utilization, buoyant bank credit, and government's continued thrust on capital expenditure are expected to support aggregate demand and output in the second half of the current year. Consumer price inflation remains elevated and above the upper tolerance band of the target due to large adverse supply shocks, some firming up of domestic demand, and the spillovers from global markets. The recent correction in global commodity prices, including crude oil, if sustained, may ease cost pressures in the coming months. The inflation trajectory remains clouded with uncertainties arising from continuing geopolitical tensions and nervous global financial market sentiments. In this backdrop, the MPC was of the view that persistence of high inflation necessitates further calibrated withdrawal of monetary accommodation to restrain broadening of price pressures, anchor inflation expectations, and contain the second round effects. This action will support the medium-term growth prospects of our economy. Accordingly, the MPC decided to increase the policy repo rate by 50 basis points to 5.9% and to remain focused on withdrawal of accommodation while supporting growth.